Ivan, I don't know what all of this means, but it means something substantial. I mean, since November, the United States has become a net importer of gold instead of a net exporter. November, interesting time frame. We've imported just from London alone north of 13 million ounces of gold, and that's just London. That doesn't take into account other places like Switzerland or Singapore or other venues. We've seen the largest delivery ever in the history of the COMEX market for the February contract of just under 6 million ounces of gold, surpassing the next largest, which was during the pandemic in 2020, QE forever, 1.2 million ounces of gold.
Wow.
I mean, so you're talking massive deliveries. The next largest in the history of the COMEX was 4.8 million or somewhere around that number, 4.7. So this is huge. We're seeing JP Morgan deposit 4 billion worth of gold into the COMEX in February. And Blythe Masters said that that's for a client. When you talk about, they don't own it for themselves. They said we only do business for clients. So what kind of client has $4 billion to put into gold? And have it delivered into COMEX. We're seeing the metal coming from London. Environment where T is the trade day, let's say Monday, or exchange is what I'm trying to say. T is the trade day, Monday, +1, Tuesday, Wednesday. In theory, your metal should be available. It's now T plus 6 to 8 weeks, and they say it's because of lack of manpower and of trucks.
Wow.
We've seen the lease rates spike. Which is always a troubling sign as well. Now they've normalized a little bit, but they definitely spiked. We're seeing the spread between London and New York. You buy in London, sell in New York. At one point, it was $80 an ounce. It's come back a bit, but this signals massive strain in the market. And whatever we're seeing, all I can tell you, whatever we're seeing is way off the charts, Ivan. It's an anomaly in terms of anything I've ever seen in my career. And it seems to be American-centric. It seems to be we're reshoring the gold. Now, what are they going to do with it? Are they going to follow Judy Shelton's lead and collar it to 50-year treasuries, redeemable in gold? She told me Trump will issue them July 4th, 2026, the 250th year anniversary, that they've discussed it at length.
Wow.
Is it something else? Is it playing that spread between London and New York, but the shipping costs alone mitigate that profit? Is it backing the naked contracts that, the massive naked contracts and the rehypothecation, or the commercial banks wising up, bringing that gold home? It's not, certainly just not the Trump tariffs, whatever it is, and I'm not sure exactly what it is. Maybe it's the Basel III regulations where you have to have physical metal instead of paper derivatives. All of these things are in play. Or is it something much bigger? Are they going to revalue gold? After all, it's held in the gold revaluation account at $42.22 an ounce. That's the value of it. And that's the name of it on every central bank balance sheet. Get that. The gold revaluation account. You can't even make it up.
Wow.
In Europe, it's at $35 an ounce. But after Nixon closed the gold window in 71, he revalued it from 35 to 38 in 72, and from 38 to 42.22 in 73, where it stood forever. So on the United States balance sheet, if the gold is really there, they're going to go look. It's valued at 42.22. Just marking it to market would add 700-800 billion to the Treasury coffers. What if they go much further than that? And it's happened. It's not without precedent. I don't know. It's interesting that central banks hold gold in what's called the gold revaluation account. That's in essence what Roosevelt did when he confiscated gold at $20.67 or whatnot for every $20 gold coin. People were like, yeah, we're getting a premium. It's fantastic. A dozen eggs are a nickel back then, 67 cents. I think it was 2067. That's a lot of money. Well, then he revalued gold, or devalued the dollar by 40%, putting gold at 35, just like that. And so it's happened.
Right.
And then you have the head of the Dutch National Bank and members of the Bundesbank for 2-3 years screaming, let's revalue the gold, held in the gold revaluation account to offset our liabilities on our balance sheet. And even Cynthia Loomis, the senator from Wyoming, let's revalue gold, she says. Let's revalue gold so that we have the ability to buy Bitcoin for the strategic Bitcoin account. So I don't know, man. All I can tell you is this, that whatever is going on is a wicked anomaly. It's way outside the realm of what normally is. And I don't know. I guess only time will tell, but interesting times for gold no matter what.
What we are witnessing, folks, is nothing short of a global monetary system beginning to fracture at the seams. And make no mistake, this isn't about theories anymore. This isn't just speculation or gold bug chatter. We are seeing it play out in real time, right before our eyes. Let's zoom out for a second. Since the end of 2023, the United States has quietly, steadily become a net importer of gold. That in itself is seismic. You're talking about a country that for decades exported gold, trusted the dollar's reserve status, and operated under the illusion of financial dominance. Now suddenly we're reshoring the very asset that supposedly had no role in the modern monetary system. I mean, think about this. We imported over 13 million ounces from London alone, just one node in the global gold ecosystem. That doesn't include what's coming from Switzerland, Hong Kong, Singapore, or even mining operations in allied countries that might be quietly diverting supply to the US Treasury or Federal Reserve depositories. So the real number? Probably well north of 20 million ounces. And then you get the February COMEX contract, the largest physical delivery in recorded history, nearly 6 million ounces. That's 5 times bigger than the panic deliveries during COVID in 2020, when the world was on fire and monetary policy went completely vertical. That's not a coincidence. That's purposeful accumulation. And look, let's be clear. JP Morgan deposited $4 billion worth of gold into COMEX for delivery. And their own people admitted, it's not our gold. It's for a client. What kind of client is putting $4 billion into physical gold and demanding delivery, not paper? That's not a hedge fund manager with a newsletter. That's institutional, sovereign, strategic. Now you layer in the logistical bottlenecks. They tell us LBMA is suddenly T+6 or T+8 for delivery, blaming lack of trucks and manpower? Come on. Really, these are some of the most sophisticated logistics operations in the world. They're not short on trucks, they're short on metal. When you've got 380 million ounces of outstanding spot contracts against just 36 million ounces of unencumbered float in London, that's not a delay. That's a default with PR spin. And it's not just me saying this. People with boots on the ground, traders at the LBMA and refiners, are saying the same thing. They can't get allocation. Refiners are prioritizing gold over silver, and even then, they're rationing production for existing clients. New orders? Prepare to wait, or pay way over spot. But here's the kicker, and this is where things get really interesting. The spread between London spot and New York COMEX has ballooned to as much as $80 per ounce. That arbitrage only exists when there's a fundamental stress between supply and demand across those exchanges. And guess what? It doesn't favor paper. It favors those who can take delivery, who can extract physical metal from the belly of a rapidly hollowing out system. Now ask yourself this. If the West has been the historic suppressor of gold through leverage, short selling, and naked contracts, but now the West itself is importing massive quantities of gold, what does that tell you? What changed? In a word, everything. We are watching the great monetary realignment, a shift from credit-based illusion to asset-based collateral. And if you don't think that has something to do with Trump, Basel III, and the revaluation potential of gold, I've got some Zimbabwe dollars to sell you. Let me walk you through something no one in the mainstream wants to touch. It's called the gold revaluation account. Sounds boring, right? Bureaucratic, harmless. But every central bank on earth, including the Federal Reserve, has one. In Europe, the gold on those books is still priced at $35 an ounce. Yes, the 1934 price. In the US, it's $42.22. Nixon bumped it from $35 in 1972 to $38, and then again in 1973 to $42.22. Since then, crickets. But what happens if, scratch that, when the US marks gold to market? I'll tell you what happens. Just marking it to $2,100, never mind the current approximately $3,000 levels, would add nearly $1 trillion to the US Treasury general account. Just like that. No debt ceiling, no congressional votes, no bond issuance. Just a revaluation. It's legal. It's been done before. Roosevelt did it in 1933, Nixon did it in 71, and you better believe they'll do it again. This is not about getting rich. It's about not getting poor. And right now, gold and silver are not just investments. They are your only monetary exit strategy from a collapsing system that's running out of tricks. Are you ready?
since several years now. For several years, we have not seen any central banks net buy bonds. More have sold than bought. They're all buying gold. And so this is a situation where I don't think we've seen anything yet. And maybe it's a realization by Trump that this is a game, as Zoltan Pozsar says, he who has the gold makes the rules. He said Bretton Woods 3, we're moving into a system that's all about commodities and transparency. Blockchain, gold, we're moving there. So maybe Trump is ahead of the curve here and is onshoring our gold before it gets siphoned off across the globe, because we were so stupid in the West for all of these years to suppress gold and silver, playing right into the hands of the countries that are saying, thank you, we'll stand for delivery. And that's what's different than anything I've ever seen. These countries are sophisticated, motivated, coordinated, and wealthy. Give me the damn metal. I don't want more paper. What we see now is certainly intriguing and outside the norm. But when you start to see a run on these institutions, force majeure on the COMEX, God only knows what on the LBMA, I think it could get interesting, and maybe it's just tariffs. Don't know, but these are the times we live in. Very fluid, very interesting, certainly worth keeping your eye on the ball. Because we're talking about gold, look, many of the same things are happening with silver too, Ivan, and maybe in spades. To me, I'll just say this regarding silver, and I know that's what your listeners predominantly own and think about and research. Only the duality or plurality, that's a word, in demand between military and green and digital and monetary.
Yeah.
Except it's depleting in nature, increasing in demand, been held down in price forever, probably by the military industrial complex so they can make high-tech weapons. But whatever it is, I don't know that there's an asset that offers the upside that silver does with the mitigated downside. And we've seen, 14, 15 million ounces of silver stand for delivery recently also, if not more. I haven't seen what happened here just recently, the recent commitment of traders. But there's a lot of silver coming in to the U.S. as well. It's not just gold that's being imported. So as one goes, so too does the other. They have about a 90% correlation through all of history. Maybe not in perfect unison, but one won't go to the moon without the other. So I know we said gold, but I'm just as bullish and probably more bullish on potential on silver.
Now look, I don't know exactly what all of this means, but it means something big. When the United States, a country that has always been a net exporter of gold, suddenly becomes a net importer, and not just by a slim margin, but in record volumes, that's not business as usual. That's not, we're just reallocating inventory. No, my friends, this is a once-in-a-lifetime anomaly. Since November, and that date matters, we've imported over 13 million ounces of gold from London alone. Let that sink in. We're not just talking about your average market flows. We're talking about a tectonic shift in monetary behavior. And remember, this is just from London. It doesn't even factor in other major gold vault hubs like Switzerland, Singapore, or Hong Kong. We don't even know the full scale. And then you look at what's happening at COMEX. In February, we witnessed the largest physical gold delivery in the history of the exchange, just under 6 million ounces, dwarfing the previous pandemic-era peak of 1.2 million ounces in 2020. Let me repeat that, 5 times larger than what we saw during the height of the pandemic, during QE infinity. These aren't minor fluctuations. These are earth-shaking, table-pounding moves. This isn't about speculation anymore. This is about repatriation, sovereign wealth, strategic positioning, and quite possibly a reorganization of the global monetary system. JP Morgan, yes, them again, has deposited roughly $4 billion worth of gold into COMEX. Now you might say, okay, well that's a lot, but for who? The bank says it's for a client. Well, what kind of client drops $4 billion into COMEX for physical delivery? Not an ETF, not a speculative hedge fund. No, someone with serious geopolitical motive and financial muscle. The kind of client who doesn't want promises, they want bars, and that's a major tell. Meanwhile, across the Atlantic, we've got delivery delays at the LBMA. What used to be T+2 settlement, you trade Monday, delivery by Wednesday, has ballooned to 6 to 8 weeks. They say it's a shortage of trucks and manpower. Please. We've been delivering gold for decades without these kinds of manpower problems. What we're really seeing is systemic strain. There's a quiet panic brewing underneath the polished surface of the Western gold markets. Even more telling are the lease rates and the London-New York spread. You could buy gold in London and sell it in New York with a margin of $80 an ounce. Now think about that. That spread should not exist under normal market conditions. That's arbitrage on steroids, until you factor in the shipping delays, insurance risks, and market volatility. But the fact that this spread even existed tells you the system is misaligned. It's breaking apart at the seams. All of these signs, the repatriation, the importation, the physical delivery, the spreads, the lease rates, are screaming the same thing. This system is in the early stages of a full-blown transformation. And this transformation, make no mistake, is centered right here in the United States. Now here's the million-dollar, or maybe I should say trillion-dollar question. What is all this gold for? Is it Judy Shelton's plan taking shape? The issuance of 50-year treasuries, redeemable in gold, collared to physical metal, backed by a blockchain ledger of transparency and accountability? Shelton told me that Trump wanted to issue those bonds on July 4th, 2026, America's 250th birthday. That's just over a year away. What better way to launch a reset of faith in the dollar than to say, here's a long-term, gold-backed, verifiable bond to replace the debt-junked fiat garbage we've been issuing for decades? Or is it Basel III? After all, come July 1st, 2025, the U.S. officially comes under full Basel III compliance. And what does Basel III say? Only fully allocated, physically held gold on your balance sheet can be treated as Tier 1 capital. All the unallocated paper nonsense? That's done. That's toxic. So what are commercial banks doing? They're reshoring, unloading unallocated paper and taking possession of physical bullion. This could be nothing short of a monetary house cleaning, a return to sound money, a return to real collateral. And by the way, let's talk about the balance sheet. You want to talk numbers? Gold is held on the U.S. books at $42.22 an ounce. Not a typo. $42. That's the same valuation Nixon repegged gold to in 1973 after closing the gold window in 71. It has sat there for 50 years, unchanged. Meanwhile, the market has done its thing and taken gold to nearly $3,000 an ounce, an increase of 7,000%, and yet the official books haven't budged. But here's where it gets interesting. Let's say the U.S. government does what central banks like the Bundesbank and the Dutch National Bank have been calling for: mark gold to market. Just doing that, just revaluing the 260 million ounces supposedly held at Fort Knox and the Federal